I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price.
In today's news recap, price pullback spurs gold demand in top Asian hubs. Physical gold demand improved across most key Asian hubs this week as a pullback in global prices sparked buying interest among consumers. This week, Indian dealers were offering a discount of up to $34 an ounce over official domestic prices, inclusive of 6% import and 3% sales levies, compared to last week's discount of up to $16. Demand was better this week compared to last, thanks to the price drop. But a lot of buyers are still waiting it out, hoping prices dip even more, said a Kolkata-based bullion dealer. Prices need to settle down a bit. If gold drops another 2,000 rupees and hovers around 90,000 rupees, we could see demand really take off, said a Mumbai-based bullion dealer with a private bank. Spot gold trading around $3,216.17 on Friday. It hit an over 1 month low of $3,120.14 on Thursday and is set for its biggest weekly decline since November. Dealers in top gold consumer China charged premiums of $9 to $50 an ounce over the global benchmark spot price, compared with premiums of $42 to $49 last week. The correction in gold prices has for sure encouraged some bargain hunting and a good entry point for those who may have missed the move higher, said Ross Norman, an independent analyst. We expect jewelry demand to stabilize over the coming quarters. Retail investment demand will likely be strong, given the compelling investment case for gold, ANZ said in a note. In Hong Kong, gold was sold at par to a $2 premium, while in Singapore, gold traded at par with the global benchmark to a premium of up to $2.50 per ounce. In Japan, bullion was sold at a premium of 25 cents to 50 cents. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
While the stock market was rallying and, gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning, and, it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. it's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price.
In today's news recap, gold and HQLA correcting misleading online information. There have been inaccurate reports online that gold will be reclassified as Tier 1 HQLA, high quality liquid asset, under Basel III as of July 1st, 2025. This information is not correct. No official announcement has been made or is expected on gold gaining HQLA status. Why is there confusion? There's a lot of online misinformation about Basel III more broadly. Related to gold specifically, various websites state that gold will be reclassified as Tier 1 HQLA on July 1st. Let's pause here. Tier 1 refers to capital rules that were written in the original Basel Accord in July 1988, which became known as Basel I. HQLA is a function within the liquidity rules of LCR and NSFR, which were first written into Basel III and implemented by Basel on January 1st, 2019. People are getting mixed up between capital rules and liquidity rules. LBMA is advocating for gold to be reclassified as Level 1 HQLA. Again, note this isn't Tier 1 because HQLA relates to a liquidity rule. A lesser number of articles say that gold is due to become Level 1 HQLA. But again, this isn't correct. As stated above, no announcement has been or is expected. Gold is already a Tier 1 asset under the Basel Capital Accords, meaning that it has a 0% risk weight. This is true for all three Basel Accords. The rule states that gold held in a bank's own vault is deemed as a Tier 1 asset with a 0 risk weighting. Nothing has changed since the original Basel I Accord was created in 1988. Gold is not due to be reclassified as a Level 1 HQLA. If it were, we and the WGC would be the first to shout about it. LBMA continues to advocate with the central bank and prudential regulatory community that gold meets all criteria to warrant HQLA status. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
And the other market that hasn't recovered anywhere near its losses is the dollar. Yes, the dollar index has recovered somewhat. It's back above 100, but barely. The dollar index right now is at 100.7. Yes, it did dip below 98 one day, but I think the dollar index was up around 104 or 105 before Liberation Day. So the dollar has been marked down and bonds have gone down. Yeah, we've got a rally in the stock market, but I think that it is meaningless. Yes, we got some people that got short. They covered. Some speculative money came back into the market. I think we're getting ready to roll back over. I do not expect the market to make new highs. I think it's more likely that we make new lows. Now, not when I'm talking about new lows, not record lows, but we take out the post-Liberation Day lows. I don't think those lows are it. I don't think that's the low of this decline. I think we're going to go lower, and we may go quite a bit lower after this bounce runs out of steam. And maybe it already is running out of steam. You know, I mentioned on the last podcast that Bitcoin didn't seem to be going along for the ride, and that's continued. Even though the stock market has rallied over the course of the week, Bitcoin has not. I mean, Bitcoin right now is around 103 and change, and that's where it's been. It hasn't made a new high, and it's kind of been going sideways, and maybe it's about to roll over. You know, it got some good news in that Coinbase was added to the S&P 500 and rose about 20, 30% over the first couple of days, although it was down today quite a bit. Apparently, it's got hacked. I forget how much money it lost, several $100 million from a hack. And now there's some other allegations about Coinbase's numbers. I think it's interesting that this is happening after Coinbase was put into the S&P 500, not before. I think this is going to be a mistake for the guys over at S&P because I do think that Coinbase is going to be adding quite a bit to the losses at for the S&P. But I mentioned that Bitcoin kind of led risk assets higher, and now it looks like it may lead them lower. Bitcoin bottomed before the NASDAQ, and it looks like it may have topped before the NASDAQ as well. And, you know, I was listening on CNBC. I was listening to an interview with Jim Chanos, who mentioned that one of his big shorts was MicroStrategy. And I think that's a great short. But he also mentioned that he's hedging it because, you know, he likes to hedge his bets. So he's long Bitcoin. He's not long Bitcoin because he wants to own Bitcoin. He just wants to limit his risk in being short MicroStrategy. Because if Bitcoin goes up, well, MicroStrategy can go up too. But ultimately, Bitcoin's going to crash a lot more. I mean, MicroStrategy is going to crash a lot more than Bitcoin because MicroStrategy is trading at a big premium to Bitcoin, and MicroStrategy has a lot of debt. And MicroStrategy could be forced to sell its Bitcoin at a very inopportune time, at a very inopportune price. So he owns Bitcoin, but not because he wants it, but because he wants to limit his risk in his short position, which prompted me to finally concede that there is, in fact, a use case for Bitcoin. You know, I've been downplaying the fact that, hey, you know, there's no real use case for Bitcoin. Nobody needs it. Well, yes, there is a use case for Bitcoin. You could use it to hedge your short position in MicroStrategy. So there you go. You know, Michael Saylor has ironically actually created a use case for Bitcoin. You could use it to limit your risk when you short MicroStrategy stock.
What's your take on Salente's new outlook? Do you think $3,000 gold is realistic this month, or are there more hurdles ahead? Will central banks continue to gobble up all the gold? It's funny that Gerald Celente has shifted his forecast after being bearish for like 2 weeks, becoming bullish on gold as he sees current market conditions driving prices higher. Share your thoughts and price predictions in the comments. Let's see how this plays out in the coming weeks. Now, watch this video right here because it's a perfect fit for you, and I'll see you on the other side.